$318 trillion. That's not a forecast. That's not a projection someone pulled from a worst case economic model. That's the actual amount of debt currently outstanding in the global financial system, according to the Institute of International Finance's latest assessment. Think about that number for a moment. It's so large it barely registers as real. Now, consider this. The entire world economy, the sum total of everything humanity produces in a single year, amounts to roughly $105 trillion, which means we collectively owe 3 times more than we collectively earn. The math doesn't work. It can't work. And anyone who tells you it can work is either lying or doesn't understand how debt functions. And in the middle of this impossible arithmetic, silver trades at $64 per ounce. If you understand why that matters, if you can see the connection between unpayable debt and undervalued monetary metals, then what I'm about to show you will change how you think about financial security entirely. Because this isn't new, this isn't unprecedented. This exact sequence has played out across every major civilization in recorded history. The names change, the technology advances, the excuses get more sophisticated, but the underlying pattern remains identical. And right now, we're deep into the later stages of a cycle that always, without exception, ends the same way. Let me walk you through the mechanism, because once you see it, you can't unsee it. And once you understand it, the current situation becomes terrifyingly clear. Every currency collapse follows the same basic structure. 4 distinct phases that execute with mechanical precision, regardless of culture, technology, or sophistication. It doesn't matter if we're talking about ancient civilizations or modern democracy. The pattern holds. Phase 1 begins with sound money. A currency backed by something tangible, gold, silver, commodities, something that exists independent of government decree. This creates trust. People accept the currency because it represents genuine value. Commerce flourishes, trade expands, economies grow, everything functions because the monetary foundation is solid. Phase 2 starts when governments encounter costs they can't cover through taxation. War, expansion, social programs, corruption. The reasons vary, but the response is always the same. They begin debasing the currency, mixing cheaper metals into coins, printing more paper than they have reserves to support, expanding the money supply beyond the underlying asset base. And critically, they tell everyone nothing has changed. The currency is still good because the government says it's still good. For a period, people believe this. The debasement is gradual enough that most don't notice. Those who do notice often benefit from being early to the game. Asset prices rise. People feel wealthier. The government continues spending. Everyone assumes the good times will last. Phase 3 arrives when reality catches up. Prices begin accelerating. The currency's purchasing power visibly erodes. People start questioning whether the paper in their wallets actually holds value. Smart money begins shifting into tangible assets. Real estate, commodities, precious metals, anything that can be printed into existence. The government responds by accelerating the very policies that created the problem. They print more to cover obligations. They impose price controls. They blame external forces. This makes everything worse. Inflation accelerates. Public trust collapses. Social cohesion fractures. The system enters crisis. Phase 4 is the resolution. The currency dies, sometimes quickly, sometimes slowly, but it always dies. Either the government introduces an entirely new monetary system, or they're forced back to commodity-backed money. There's a reset, wealth gets redistributed, often violently. Political structures change. Sometimes regimes fall entirely, and critically, the people who held real assets before this phase survive. The people who trusted the paper lose everything. This isn't theory, this is documented history repeating with disturbing consistency. Let me show you 3 times this pattern exactly as described. Rome, 1st century AD. The empire at its peak, dominant military, advanced infrastructure, sophisticated trade networks. The denarius, their silver coin, is one of the most trusted currencies in the known world, approximately 95% pure silver under Augustus. A sound monetary foundation supporting an expanding empire. Then Nero takes power, 64 AD. The Great Fire destroys much of Rome. Wars with Parthia drain resources, civil conflicts demand funding, the Jewish revolt requires military expenditure, and the silver mines can't produce fast enough to cover what the emperor needs to spend. Nero makes a choice. He reduces the silver content of the denarius to 80%. Same coin design, same face value, less actual silver. This allows Rome to mint more coins from the same amount of metal. Problem temporarily solved, but a precedent has been set. Fast forward to Septimius Severus in 197 AD. He wants to secure military loyalty by doubling soldier pay, but he can't afford it without further debasement. The denarius drops to 46% silver. His son Caracalla introduces a new coin in 215 AD, supposedly worth 2 denarii, but containing only 1.5 times the silver. The debasement accelerates. By the time Gallienus rules in the 260s, the silver content has collapsed to 5%. What began as a silver coin is now essentially bronze with a silver wash. The currency has been gutted from the inside. What happens to the Roman economy? Grain prices triple. Soldiers refuse payment in debased coins. They demand goods instead. Merchants hoard old coins with actual silver content. Bad money drives good money out of circulation. The economy partially collapses. Trade contracts. Regional economies start operating on barter. By 310 AD, Constantine is forced to create an entirely new monetary system just to restore basic functionality. The old denarius has become so worthless it takes millions of them to equal one new gold coin. The currency that built an empire has been destroyed through debasement. Same pattern, all 4 phases. And Rome was the dominant superpower of its era, the most advanced civilization of its time. If it could happen to them, it can happen to anyone. Let's jump forward to Weimar Germany, 1914 to 1923. The German mark was one of the strongest currencies in Europe before World War I. Backed by gold, trusted internationally, solid foundation. Then the war begins, and Germany suspends gold convertibility. They're confident the war will be short, and the losers will pay reparations. They're wrong. Germany loses. The Treaty of Versailles imposes 132 billion gold marks in reparations. In current terms, that's over $500 billion. Annual payments consume 25% of their entire economic output. The new democratic government also wants to maintain social programs. They want to rebuild. They want to keep voters satisfied, but tax revenue covers only 37% of what they're spending. The Reichsbank begins printing to bridge the gap. Initially, it's manageable. By early 1922, it takes 160 marks to buy $1, a significant devaluation, but not catastrophic. Then the acceleration begins. By December 1922, 7,400 marks per dollar. That's a 46-fold collapse in 6 months. Then 1923 arrives. France and Belgium invade the Ruhr to seize resources as payment. The German government supports a general strike, paying 2 million workers not to work as an act of passive resistance. The printing press goes into overdrive. June 1923, 192,000 marks per dollar. October, 170 billion marks per dollar. November 4th, 2 trillion marks per dollar. People carry wheelbarrows of cash to buy bread. Restaurants change prices between ordering and paying. Workers get paid twice daily because morning wages become worthless by afternoon. Farmers refuse to accept paper currency. Cities face food shortages. The middle class is obliterated. The social and political trauma from this collapse creates conditions that, within a decade, help bring the Nazi Party to power. Economic destruction breeds political extremism. The pattern executes completely. November 15, 1923, the government introduces the Rentenmark. 1 trillion old marks equals 1 new Rentenmark. The old currency is declared worthless instantly. Everything resets. The people who held tangible assets survive. Those who trusted paper lose everything. Same pattern, all 4 phases. One of the most scientifically and industrially advanced nations on Earth couldn't prevent it. Now the United States. August 15th, 1971. President Nixon appears on television and closes the gold window. Foreign governments can no longer exchange dollars for gold. The dollar had been backed by gold at $35 per ounce since Bretton Woods established the post-war monetary system. Nixon claims this is temporary, a measure to stabilize the dollar. The window never reopened. Before Nixon's decision from 1944 to 1971, the dollar was backed by gold. Other currencies pegged to the dollar. This created the post-war economic boom, stable international trade, predictable exchange rates, a genuine monetary foundation. But by 1971, there are 4 times as many dollars circulating as there is gold to back them. The Federal Reserve has been printing to fund Vietnam, the Great Society programs, expanding government obligations. The system is already breaking. Nixon's announcement just makes the break official. After the gold window closes, all constraints disappear. The 1970s bring stagflation, oil shocks, currency chaos. The dollar collapses against real assets. Gold moves from $35 per ounce in 1970 to $850 by 1980. A 24-fold increase. That's not gold appreciating. That's the dollar being revealed for what it's become, unbacked paper with declining purchasing power. But the printing never stops. 2008 financial crisis, print trillions. 2020 COVID response, print 6 trillion in 18 months. Today, the US national debt sits at $36.1 trillion. Annual interest payments on that debt exceed $892 billion. That's more than the entire defense budget. And projections show interest payments hitting $1.7 trillion annually by 2034. Here's what this means in practical terms. Before 1971, when productivity increased, wages increased proportionally. Since 1971, productivity continues rising while real wages stagnate. The wealth gap explodes, asset prices inflate while purchasing power erodes. In 1971, someone earning median income could save to buy a house in roughly 2.5 years. Today, over 7 years. Food costs more, energy costs more, healthcare costs more, education costs more. The middle class gets squeezed from every angle. And internationally, confidence in the dollar is fracturing. Central banks are diversifying reserves. BRICS nations openly discuss dollar alternatives. China and Russia accumulate gold at unprecedented rates. Saudi Arabia is accepting payment in currencies other than dollars for oil. The foundation that supported dollar dominance for 70 years is cracking. We are in late phase 3 right now. The crisis is building. The question isn't whether phase 4 arrives. The question is when and how severe. So where does silver fit into this historical pattern? In every currency collapse throughout history, people flee to real assets. And for 5,000 years, gold and silver have served as monetary refuge, not because of tradition or nostalgia, because they possess specific properties that make them ideal money. They're scarce, they're durable, they're divisible, they're recognizable, and critically, they cannot be created by government decree. Gold currently trades around $2,300 per ounce. Silver trades at $64. That's a ratio of approximately 67 to 1. Historically, that ratio averages between 15 to 1 and 50 to 1. During periods of monetary stress, it typically tightens dramatically as silver's dual role as both monetary and industrial metal creates additional demand pressure. If the ratio simply reverted to the long-term average of 50 to 1 with gold at current levels, silver would trade at $46 per ounce. That's a 34% increase just to reach historical norms. But that's assuming gold stays constant. In every currency crisis, gold reprices dramatically higher, and silver typically outperforms gold during the repricing. Let's look at the inflation-adjusted numbers. The 1980 silver peak, adjusted for inflation, equals $194 in today's terms. The 2011 peak adjusts to $70 today. We're trading at 64. The metal that has served as money for millennia is priced as if everything is fine, as if 318 trillion in unpayable debt is manageable, as if this time is somehow different. And that's always what they say. This time is different. American exceptionalism, reserve currency status, modern monetary theory, technological innovation, strong institutions, digital transformation. They said similar things in Rome when it ruled the known world. They said it in Weimar Germany, one of the most advanced societies of its time. The pattern doesn't care about excuses. You cannot sustain 318 trillion in debt against 105 trillion in economic output. You cannot debase a currency indefinitely without consequences. You cannot print your way to prosperity. These aren't opinions. These are mathematical realities that function like laws of physics. You can ignore them, you can deny them, but you cannot break them. And when they reassert themselves, it happens suddenly and without mercy. Understanding this pattern creates a specific framework for thinking about silver. It's not speculation. It's not a gamble on price movements. It's insurance against mathematical certainty, a hedge against the inevitable resolution of unpayable debt, a position based on the recognition that history doesn't stop being history because we have smartphones and artificial intelligence. At $64 per ounce, with the gold-silver ratio at 67 to 1, with debt at all-time highs, with money printing continuing, with interest rates trapped because raising them would implode the debt structure, the risk-reward proposition is extraordinary. Not because silver is going to the moon based on speculation, because historical patterns suggest it must reprice dramatically when phase 4 arrives. Now let's dig deeper into why this debt crisis is different in scale, but identical in structure to previous collapses. Because the numbers we're dealing with are unprecedented, even if the pattern is familiar. 318 trillion in global debt represents approximately 335% of global GDP. For context, before World War II, global debt rarely exceeded 100% of GDP. Even during the worst of the Great Depression, debt levels didn't approach what we're seeing today. We've entered territory that has no historical parallel in terms of absolute scale. But here's what makes this particularly dangerous. Much of this debt is sovereign debt, government borrowing, which means the entities responsible for managing the crisis are the same entities that created it. And historically, governments facing unpayable debts have exactly three options. They can default explicitly, refusing to honor their obligations. They can implement austerity, cutting spending and raising taxes to service the debt, or they can inflate it away, printing currency to pay nominal obligations while destroying the currency's purchasing power. Explicit default is political suicide. No government chooses it unless forced. Austerity is similarly toxic politically. Voters punish governments that cut services or raise taxes, which leaves inflation. And inflation is exactly what we've been seeing. Not the 2% target central banks claim to seek, real inflation measured by actual purchasing power erosion. Look at asset prices over the past 15 years. Stocks have tripled, Real estate has doubled in many markets. This isn't economic growth. This is monetary inflation expressing itself through asset prices. The money supply expanded dramatically, and that money flowed into assets. People feel wealthier on paper, while their actual purchasing power stagnates or declines. The mechanism is subtle but devastating. Central banks keep interest rates artificially low. This makes borrowing cheap and saving pointless. People and institutions are pushed into riskier asset-seeking returns. This drives asset prices higher, but those higher asset prices don't reflect increased productivity or genuine wealth creation. They reflect currency debasement. And now we're trapped. Total debt is so large that even modest interest rate increases create unsustainable debt service costs. The US government is already paying more in interest than it spends on defense. If rates rose to historical averages of 5 to 6%, interest payments would consume the entire federal budget. Social Security, Medicare, all discretionary spending would need to be funded through additional borrowing. The debt spiral would accelerate catastrophically. This is the trap. Rates must stay low to prevent debt collapse. But keeping rates low encourages more borrowing and more monetary expansion, which creates more inflation, which erodes purchasing power, which requires even more monetary expansion to maintain the illusion of growth. It's a doom loop with no exit that doesn't involve severe pain. Now, overlay this with demographic trends. Aging populations in developed economies mean fewer workers supporting more retirees. Social security and pension obligations are growing exponentially just as the tax base needed to fund them is shrinking. These are structural deficits that can't be solved through growth or efficiency. They require either breaking promises to retirees or printing massive amounts of currency to honor nominal obligations. Every government facing this choice has chosen printing because the alternative is immediate political death. Breaking promises to millions of retirees creates instant political crisis. Printing creates delayed crisis that can be blamed on external factors. The choice is politically obvious, even if economically catastrophic. This is why central banks globally have been expanding balance sheets despite claiming inflation is under control. They are not preparing for future crises. They are managing ongoing crises that most people don't recognize yet. The printing never stopped after 2008. It accelerated, and it will continue accelerating because there's no alternative within the current structure. The fascinating and terrifying aspect of the situation is how it mirrors the final years of every previous currency collapse with eerie precision. The explanations change, the terminology evolves, but the substance remains identical. Governments insist everything is under control while quietly expanding money supply at unprecedented rates. Official statistics show modest inflation while actual cost of living soars. Asset holders feel wealthy while wage earners fall further behind. The disconnect between official narrative and lived experience widens until it becomes unbridgeable. In Rome, they insisted that the base denarius was still worth its face value, even as merchants demanded multiple coins for what one coin used to buy. The government's word was supposed to be sufficient. It wasn't. In Weimar, they insisted the mark's value was stable even as prices doubled weekly. They blamed speculators and foreign manipulation. The real cause was the printing press running continuously. Today we're told inflation is transitory even as shelter, food, and energy costs consume ever larger portions of household budgets. The specifics differ. The denial is identical. This denial isn't conspiracy or incompetence, it's incentive. Political leaders gain nothing from acknowledging unsolvable problems. They gain everything from appearing to have solutions, even when those solutions are impossible. So they claim technology will save us, that growth will outpace debt, that inflation is temporary, that modern monetary systems are more resilient than historical examples. They must believe or pretend to believe these things. because admitting reality means admitting the system is doomed. But here's what makes the current situation uniquely precarious compared to historical precedents. Previous collapses were largely regional. Rome's currency failure affected the Mediterranean world, but not Asia. Weimar's hyperinflation devastated Germany, but didn't directly destroy the pound or dollar. Even the US departure from gold in 71 had significant global impacts, but other currencies initially maintained some stability. This time the crisis is global and interconnected. 318 trillion in debt isn't concentrated in one economy. It spans every major nation. The US holds 36 trillion. China's total debt, including local governments and state enterprises, exceeds 50 trillion. Japan's government debt alone is over 10 trillion. Emerging nations collectively hold similar amounts. Emerging markets have borrowed heavily in dollars, creating vulnerability to currency swings. This means there's no external rescuer. When Weimar collapsed, other nations with functioning currencies could provide some stability. When the dollar left gold, other currencies existed as alternatives. Today, virtually every major currency is simultaneously debasing. They're all trapped in the same debt spiral. They all face the same impossible choice between default and inflation, and they're all choosing inflation. The implication is staggering. When the reset comes, it won't be one currency collapsing while others remain stable. It will be a coordinated restructuring of the entire global monetary system, because the interconnection of modern finance means systemic crisis in one major economy immediately threatens all others. We saw this in 2008 when US housing crisis became global financial crisis within months. The next crisis will spread even faster because the connections are tighter and the buffers are thinner. This is why silver's role becomes even more critical than in previous collapses. Historically, when one currency failed, people could flee to other currencies temporarily while also holding precious metals. The metals provided insurance, but currency alternatives existed. In a global synchronized crisis, there are no stable currency alternatives. The flight to real assets becomes the only option, not a hedge among many options. The only option. Now consider what this means for silver specifically versus other real assets. Gold serves as monetary insurance and central banks hoard it for this reason, but gold's price already reflects some of this understanding. It's trading near all-time high, central bank buying has been strong, professional money managers treat it as legitimate portfolio component. The market isn't ignoring gold, but silver remains mispriced relative to the same dynamic. Despite serving similar monetary function historically, despite having industrial demand floor that gold lacks, despite supply being tighter relative to demand, silver trades at levels that don't reflect crisis preparation. The gold-silver ratio at 67-1 is historically extreme. During previous monetary crises, that ratio consistently compressed as silver outperformed. Why does silver outperform gold during currency crisis? 3 reasons. First, it's more affordable for average people seeking monetary protection. When savings are modest, buying 1-ounce silver coins is feasible where gold ounces aren't. This creates broader demand base. Second, industrial demand provides price floor that supports upside momentum. Gold's value is purely monetary. Silver's hybrid nature creates multiple demand sources reinforcing each other. Third, silver market is smaller in dollar terms, making it more responsive to demand surges. It takes less capital to move silver prices than gold prices. These factors combined create potential for extraordinary repricing during phase 4. We're not talking about 10 or 20% gains. Historical precedent suggests multiples. The 1980 peak represented 900% gain in 18 months. The 2011 rally saw 400% gains in 3 years, and those occurred during crises far less severe than what 318 trillion in global debt represents. Think about the mathematics from portfolio perspective. If you allocate 5% to silver at current prices and it reprices to historical inflation adjusted levels, around 190, that 5% becomes 15% of your portfolio. If it hits the 1980 inflation adjusted peak, that 5% becomes 30%. It overwhelms losses in everything else. This is proper asymmetric positioning, small allocation, limited downside, extraordinary upside if the pattern continues. But there is a critical timing consideration. Physical silver doesn't benefit you if you can't access it when needed. And during phase 4, physical availability evaporates, premiums explode, dealers run out of inventory, shipping delays extend to months, government may even restrict private ownership, claiming national emergency. This has happened before. In 1933, the US government banned private gold ownership. Citizens were required to surrender gold coins and bullion at fixed prices well below market value. Those who complied lost wealth. Those who hid it preserved wealth but risked prosecution. The time to accumulate physical silver is now, during phase 3, when availability exists and premiums are reasonable. Waiting for confirmation means missing the opportunity entirely. By the time mainstream financial media acknowledges currency crisis, by the time your neighbors are discussing precious metals, by the time official statistics can't hide the problem, physical silver will be effectively unavailable at any reasonable price. This is also why paper proxies for silver exposure are inadequate during phase 4. ETFs, mining stocks, futures contracts, they all depend on functioning financial system. They all carry counterparty risk. When confidence collapses, when liquidity disappears, when settlement fails, paper claims become questionable, physical metal in your possession carries no counterparty risk. It exists independent of institutional functionality. A lesson from every historical currency collapse is consistent on this point. People who held paper claims on gold or silver often couldn't redeem them, government imposed restrictions, institutions failed, settlement procedures broke down. But people who held physical metal maintain wealth across the transition. The format matters, not just the exposure. Physical possession is what survives regime change. Now consider what this means for silver specifically. Total above ground silver available for investment is estimated around 2 to 3 billion ounces. Sounds like a lot until you consider there are $56 trillion in global money supply and 318 trillion in total debt. If even 1% of global wealth attempted to flee into silver, that represents over $3 trillion chasing at most 3 billion ounces valued at current prices around 200 billion total. The supply-demand imbalance would be catastrophic. This is why silver's repricing potential during crisis isn't speculative theory. It's mathematical necessity. The physical supply doesn't exist to absorb a significant fraction of currency fleeing debasement. Prices must adjust to whatever level destroys enough demand to match available supply. And when people are fleeing currency collapse, price becomes secondary to availability. They'll pay whatever is necessary to acquire physical metal. Now let's talk about what this means practically for different people in different situations. Because the framework is clear, but implementation varies based on individual circumstances. For younger people with decades until retirement, silver allocation can be more aggressive. You have time to weather volatility. You have earning power to recover from mistakes. Allocating 10 to 20% of investable assets to physical silver makes sense. This provides meaningful protection if crisis arrives while you are still accumulating wealth. And if crisis doesn't materialize for decades, you are still holding an asset with industrial demand flow. For people near retirement, already retired, the calculation shifts. You can't afford catastrophic loss. You need income, you need stability, but you also can't afford currency debasement destroying purchasing power. Allocating 5 to 10% to silver provides insurance without creating excessive portfolio volatility. You're protecting against tail risk without betting the retirement plan. For people with significant wealth, the question becomes not just protection, but preservation across generations. In this context, silver serves as intergenerational wealth transfer vehicle. It survives currency resets. It can be physically transferred without financial system involvement. It holds value across political regime changes. Allocating 15 to 25% to combination of gold and silver makes sense for dynastic wealth preservation. The common thread is that everyone needs some exposure. The specific allocation varies, but zero is wrong for anyone because the pattern is clear, the debt is unpayable, and history shows precious metals are what survives when currencies fail. Now consider what this means for silver demand over the next decade. Industrial demand continues growing through solar, electronics, batteries. That's 50 to 70 million additional ounces annually absorbed by structural technological trends. Investment demand has been modest recently, but historically surges during crisis. If investment demand returned to 2011 levels, that's another 150 million ounces annually. And monetary demand during full crisis could easily add 200 to 300 million ounces. Add those together and you're looking at potential demand increases of 400 to 500 million ounces annually during crisis period. That's half of total global production. Where does it come from? It doesn't. Supply can't adjust that quickly. Mining takes years to expand. Recycling can scale fast enough. The only adjustment mechanism is price. This is why silver's potential repricing isn't about speculation or hope. It's about inevitable mathematics. When demand shock hits constrained supply, the pattern has played out before. It will play out again. The only question is whether you positioned before it became obvious. What makes this particularly urgent is the velocity at which phase 3 transitions to phase 4 once the tipping point arrives. These transitions don't happen gradually with clear warning signs. They happen suddenly when collective psychology shifts from trust to panic. One day the system appears stable. The next day everyone simultaneously realizes it isn't. And the scramble for real assets begins in earnest. We can see the precursors already forming. Central bank gold purchases at record levels, billionaires quietly accumulating hard assets, smart institutions diversifying away from pure paper exposure, political rhetoric increasingly acknowledging unsustainable fiscal trajectories. These aren't random events. These are the early moves by those who understand the pattern and recognize where we are in the cycle. The retail investor, the average person, typically sees these shifts last. Not because they're stupid, but because they rely on mainstream sources that have incentive to maintain confidence until maintaining confidence becomes impossible. By the time financial media broadly acknowledges currency crisis, by the time it becomes dinner table conversation, the positioning opportunity has closed. Physical metals trade at enormous premiums if available at all. The window has shut. This is why acting on pattern recognition rather than confirmation matters so profoundly. Confirmation comes too late. Pattern recognition allows positioning while prices remain reasonable and availability exists. The people who preserved wealth through previous currency collapses were those who recognized pattern early and acted before consensus formed. The people who waited for confirmation were the ones standing in breadlines wondering how it happened so fast. The 318 trillion debt isn't going away. It can't be paid back through growth. It can't be taxed away without destroying what remains of the productive economy. The only realistic path is debasement through inflation. And that path leads inexorably to phase 4. The timing remains uncertain, but the destination is mathematically determined. Silver at $64 represents extraordinary opportunity for those who understand this reality and position accordingly before the obvious becomes obvious to everyone. There is also a psychological element to consider that often gets overlooked in purely technical analysis. The transition from phase 3 to phase 4 isn't just economic, it's psychological. It's the moment when collective belief in the system breaks, when enough people simultaneously lose faith in promises printed on paper. When the emperor has no clothes becomes consensus rather than fringe opinion. The psychological shift is what creates the acceleration that catches most people off guard. Economic deterioration can be gradual, debt can accumulate slowly, purchasing power can erode year by year. People adapt to these changes incrementally without recognizing the pattern, but the psychological break happens suddenly, and once it happens, there's no going back. Trust, once lost, cannot be easily restored. We are seeing early signs of this psychological shift now. Younger generations increasingly skeptical of traditional finance, growing interest in alternative currencies and assets, declining trust in institutions across the board, rising awareness of systemic problems, even if solutions remain unclear. These are the tremors before the earthquake. Not the earthquake itself, but indicators that stress is building. The people who position for phase 4 before it arrives are the ones who recognize these psychological indicators matter as much as the economic fundamentals, because markets are made of people, and people act on emotion and belief as much as rational calculation. When belief shifts, markets reprice violently, and those who anticipated the shift benefit enormously, while those caught unaware suffer catastrophically. Silver at $64 exists in a world where most people still believe the system is fundamentally sound, where debt is seen as manageable, where currency debasement is dismissed as necessary policy rather than existential threat. But that belief is fragile, built on assumptions that cannot withstand much additional stress. And when those assumptions break, when the psychological shift occurs, silver won't be trading at 64 anymore. It will be trading at whatever price reflects the new reality of currency instability and flight to tangible assets. The opportunity exists now because the psychological break hasn't occurred yet. Most people remain comfortable, trusting, believing that governments and central banks have everything under control. That belief creates the mispricing, and that mispricing creates the opportunity for those who understand that 318 trillion in debt represents not just an economic problem, but an unsolvable mathematical impossibility that will eventually force a psychological reckoning. 318 trillion in debt, 105 trillion in GDP. Silver at $64, the numbers tell you everything. The pattern confirms it. History validates it. The question is whether you're willing to act on that understanding before phase 4 begins. Because once phase 4 starts, opportunity disappears. Physical metal becomes unavailable, premiums explode, access requires connections and luck rather than just capital. The window for strategic positioning exists now. Tomorrow it may not. The debt crisis isn't coming, it's here. The currency debasement isn't theoretical, it's happening. The pattern isn't complete yet, but phase 4 is approaching. Silver at current prices represents extraordinary asymmetry between risk and potential reward, not because of speculation, because of pattern recognition applied to observable reality. Understanding this changes everything. It shifts perspective from chasing returns to preserving wealth, from trusting institutions to taking personal responsibility, from believing official narratives to recognizing historical patterns. And that shift in perspective is what separates people who survive currency transitions from people who get destroyed by them. The machine is running, the pattern is executing. Phase 4 is approaching. Silver at $64 won't last when phase 4 arrives. The question is whether you'll be ready, or whether you'll be one more person who saw the pattern too late and paid the price for that delay. History doesn't wait for consensus. It rewards those who recognize pattern and act, while others remain complacent. 318 trillion in debt guarantees a resolution. And every historical precedent shows that resolution involves precious metals repricing dramatically against failing currencies. The pattern has spoken. The question is whether you're listening